Thanks, Dave. So we're going to take 40 minutes or so here to discuss the current state of the market in the light of option indicators and a few other technical indicators. Things are a little wild these days, as you can certainly tell. Um, just a quick background on our company. I started the company in 1990 as a derivatives research firm, newsletters, data, that sort of thing. And then we moved into money management in the last 10 years or so. So we're managing individual option accounts, both SPY options as SPX options as an RIA. Also, we do a certain amount of option education seminars like this, and we have a mentoring division as well. Today, I'm going to be offering a special to one of our newsletters, the daily volume alerts, which I'll discuss a little bit more in detail later. But this URL at the end, bottom of the page here, optionstrategist.com/festival, will take you right to the discount page for this newsletter that comes out daily. We have four main indicators that we look at in terms of the market. The first is the chart of the S&P 500, which is pretty interesting right now. We also look at equity-only put-call ratios. We look at market breadth. We have an option twist on that. And then we do quite a bit with volatility. And we'll finish up by talking a little bit about some seasonal patterns. So as we go through this, I have a couple of rules. I think they're very important rules. One, in a bearish market, oversold does not mean buy. You have to wait for confirmed buy signals. The most recent time this was really very obviously true is December of 2018. And conversely, overbought does not mean sell either. This market was overbought for, I'd say, well over a month and kept going higher. And eventually, we did get some sell signals. So here's the current chart of the S&P 500. It doesn't have today's action in it. Today, market rose from about this, the 3250 level, roughly up here, just above 3300. The moving average, 20-day moving average is right there. So it's been a nice bounce off this 3220 level, and you can see that earlier and late in the year and early this year, we also bounced off that level. So that's definitely a very important level, 3220. If that gets broken on the downside, I'd say we have a fairly large rush to lower lows. On the other hand, right now we appear that we're in somewhat of a trading range between the old highs and that 3220 level. It could turn out to be something. This is what happened last August. You may or may not recall, but we had a bottom of a trading range there just above 2820 and a top of a trading range here. It bounced back and forth several times in some rather violent action, big down days, big up days. But in the end, it really wasn't going anywhere until it finally broke out on an upside gap there in early September, retraced a little bit, and then really took off in early October. So right now, I'm rating this chart as neutral. I don't think it's strictly bullish anymore since it broke off the highs, but it hasn't turned bearish yet either because 3220 is a crucial level. So those two numbers are not that far apart, 3220, 3340. We will break out in one way or the other pretty soon, and that's a move you can definitely follow. So just to summarize here, a close below that 32, so 30 should be 20, would be negative. There is further support down to 3180, which the night that the U.S. drone killed the Iranian general, futures traded off to 3180 that night and then back up again. So that is an established support level in a sort of odd way with overnight futures trading. So, we can still make a bullish case as long as SPX stays above the support. But if it falls below there, that would definitely turn the chart bearish. Now, you're probably aware of Bollinger Bands. When John Bollinger invented Bollinger Bands, he used the definition of volatility as the standard deviation of closing prices, which is pretty typical. It sounds like that's what it ought to be. But in math, math guys don't really do that. Black-Scholes uses the definition of volatility, realized volatility, as a standard deviation of percentage price changes. And since our modeling, all of our option modeling and everything needs to agree with Black-Scholes, that's the volatility definition that we use also. So the Bollinger Bands are modified in that regard. So we use modified Bollinger Bands for buy and sell signals. There's been some very good gains over the years. Currently, it's on a sell signal. I'll show you here. You can see on this chart, by the way, red letters are successful signals and blue ones are not, the ones that got stopped at. So here's your +4 standard deviation band. Here's your +3 standard deviation band. And most recently, you see we rose above the +4 and then closed inside the +3. And that was a sell signal about, I don't know, 10 days ago. So we did not reach the bottom band here to set up a buy signal, at least not yet. So that sell signal is still operative. You can see there were various buy signals back here over the last year, including the one in January of 2019. And then a few sell signals mostly were premature and got stopped out before the actual signal itself took place. In fact, there were 3 of them in the last couple of months. So, you know, we don't rely obviously just on one indicator, but we are right now holding a long put position based on this indicator. And what options do we buy when we're trading indicators like this, the SPY broad market options? We generally trade SPY options, and we generally trade them a little bit in the money because I want the option to behave very much like the underlying SPY in this case is behaving. If you buy an option that's too far out of the money, then it doesn't have the responsiveness, and that's how you can end up losing. You can be right and wrong at the same time. You're right on the movement of the underlying, but you're buying an option that's such a high speculation that it doesn't make any money for you. So the delta of a call option ranges between 0 and 1. We tend to buy options when we're trading these things that have an option, a delta of 70 or higher. So that's 1 or 2 strikes in the money. As I said, we buy SPY calls or puts. And typically, what we're looking for is, we have pretty good track record with our directional prediction of the index. We're looking for an option that's going to reflect that prediction. And so that might be a little more expensive option in terms of just absolute price, but it's also going to have a lot of success because it's going to track the movement of the index quite well. Moving on to the next indicator, put-call ratios. These were invented by Marty Zweig back in the 1950s, and he would get the volume of the puts and calls out of ads that ran in Barron's on Sundays, where the put-call dealers would advertise how much volume they'd done during the week. Nowadays, of course, everything is computerized, and the millions of options trade every day. So it's a different game, but it's still useful as a contrary indicator. So we use the equity-only put-call ratio, which is all stock options that trade, as our proxy for predicting the broad market, and I'll show you why in a minute. And the theory is this: if too many people are buying puts, then everyone is bearish, and we want to be bullish. Conversely, if everybody's buying calls, then they're too bullish, and we want to take the opposite, contrary opinion and be bearish. So we'll define what too much is in order to quantify this a little bit. We don't just use vague terms like that. So let's talk about the ratio there. Let's suppose that we're at the end of the day, we're looking at IBM options, and we sum up all the puts that were traded. Separately, we sum up all the calls that were traded and divide the two. That's the put-call ratio. Now, this is the way Marty designed it, and puts are in the numerator of the fraction. So a heavy put buying will drive the ratio higher. But of course, heavy put buying typically occurs when a stock is going down. So when the underlying is going down, the ratio will be going up. They're moving opposite direction. In a similar manner, calls are in the denominator of this fraction. So heavy call buying will drive the ratio lower. But heavy call buying typically takes place when stocks are rising. So again, moving in the opposite direction. We'll look at some charts in a minute. We keep a moving average 21 days just in case there's something to Fibonacci, but you need to smooth out this data a little bit. So ideally it would look like this: the stock price on the top, the put-call ratio on the bottom, and they would have this perfect inverse symmetry with one another. And typically what would happen, let's say here the stock is falling, falling, falling. As that's happening, people are buying puts, buying puts, buying puts. So during the trend, the public is right. But then we get to this point here and people are just exhausted with the put buying and it starts to fall off. So a local maximum or a peak here in the put-call ratio is a buy signal for the underlying stock, and then hopefully it would take off to the upside. And then you've got heavy call buying, forcing the ratio lower. Eventually, a local minimum in the put-call ratio chart is a sell signal for the stock. So this is not a current chart, but it demonstrates my point. On top is the S&P 500 index. On the bottom is the equity-only put-call ratio. So you can see the pretty clear inverse symmetry that exists most of the time. And that's why we use the equity-only put-call ratio as a predictor of the broad market. So here's the current chart of the equity-only put-call ratio. We had the local maximums are buy signals. So for example, it was a nice local maximum there in last January and then various ones during the year. And the most recent one was like mid-October. And that one lasted for a long time. You can see they were driving the put-call ratio lower and lower. Eventually, a couple of weeks ago, finally a local minimum was formed on the chart, and that's a sell signal. So that was a pretty well-timed sell signal. That's right up there in the peak of the chart. These are intermediate term indicators, so you can see maybe trades 8 times a year, something like that. To me, that's intermediate term. So we generally are in these signals for a while when they occur. We're not just hopping in and out of them every few days. Now, as computers have come along, we're able to compute the weighted or dollar weighted put-call ratio, and we calculate it this way. At the end of the day, we take the options closing price times the volume it traded that day to give us the amount of dollars that were spent on that option. Now, technically, you could do that for every trade and add them up, but that's expensive in terms of data and time and computer power and everything else. So we don't really do that. We found it's just as useful to use closing prices. So again, we make that calculation, let's say for every option in IBM, and then we sum them up for all the puts. Separately, we sum them up for all the calls, and that's the weighted put-call ratio. So now we're measuring the dollars being spent in bearish opinion versus the dollars being spent on bullish opinion. And a lot of times the signals occur about the same time, but they're from much larger extremes. For example, here's the current weighted, again, this equity only, so we're still talking about stock options only in the weighted equity only put-call ratio, again, averaged over 21 days. And you can see, for example, the extreme height of the buy signal last January. 190, by the way, means $190 were being spent on puts for every $100 being spent on calls, which for stock options is a huge number. So we can see it came back and forth. We had a local maximum buy signal in October. This one actually did try to give an early sell signal, but quickly rolled back to a buy, and now has given another sell signal just about the same time as the previous chart right in there. So both of these ratios are on sell signals. They're coming from extreme lows. This is a very overbought situation here. Less than $60 being spent on puts for every $100 being spent on calls across the entire universe of all stock options that are trading. That's the lowest that one had been since early 2018 when the market broke down badly. And the standard chart, the other one we looked at, that's the lowest that one has been in about 7 years. So these are extreme overbought conditions. Again, they were not sell signals though until a couple of weeks ago. So those signals have been pretty good. We usually play them. We don't skip them, for example. And right now we're on sell signals from extreme overbought levels. so this indicator is bearish. So when we're trading these, by the way, I mentioned that we're looking out a little bit longer term than we might say like a Bollinger Band signal or something like that. And so in that case, we're going to buy an at-the-money option because we're trying to balance the cost of the option. And since we're buying a longer-term option, or maybe a 3 or 4 month option, it's going to be a little more expensive. But we also want some responsiveness. So an at-the-money option has a delta of about half or a little bit bigger than half, a call option. And so when we buy this, we get some responsiveness if the underlying move is right in our favor. But on the other hand, we're not risking as many dollars as we would be if we bought an in-the-money option. You might ask about spreading too, vertical spreads. Vertical spread is where you buy a call, say at the money, and you sell a call with a higher strike against it. I don't really like that strategy too much unless the options are expensive. When the options are cheap or fairly priced, and we publish a lot of charts on our website showing volatility charts, over 1,000 every day in an area that we call the strategy zone. You can see if an option is expensive or not. Now, I realize on TV, all these option traders, all they do is spread, but in real life, real option traders don't spread that much. They spread sometimes when the options are expensive, but on the other hand, you cut off your profit potential. And I know they always say, well, you're lowering your risk. Well, no, your risk is still 100%. So if you're worried that much about the dollar risk, then buy a few less calls than you would have done spreads, but both of them have a so I only use the bull or bear spread when implied volatility is high. So for example, when VIX rose up a few days ago, we got a couple of sell signals. In those cases, we did do bear spreads because VIX was high. But most of the time, we are just strict buyers of slightly in the money or at the money options for these trades. So let's look at some individual put-call ratio charts. These are kind of interesting too. Again, the nomenclature is the same. Red is a positive signal, blue is not, and in this case, where I drew this, green was a fairly fresh signal. So with the individual stock and ETF and futures put-call ratios, we will only use the local maximums and the local minimums when they are in the 90th percentile or below the 10th percentile. So at the time, this local maximum was in the 90th percentile. There were no higher readings back there. And it was okay. The stock went up. But then when the tariffs got rolling this last summer and everything, the put-call ratio went higher, formed a little peak, then went even higher, then crazily higher to where we were up over 4,000. Again, remember that means $4,000 being spent on puts for every $100 being spent on calls. Well, that was pretty crazy. And so we were long this in a number of our publications. And since then, I changed those green letters to red because the stock edged higher and then broke out to the upside. So we were still in it until last Friday. The last of our long calls expired. Now you might wonder, how do we exit these things? Well, you'll see here that we were in this thing, and the last time it peaked there, came all the way down and made this extreme sell signal here. But we did not want. We were already in an uptrend in the calls we were holding. So if I'm in an uptrend and I'm not being stopped out through, let's say, a trailing stop, then I will actually begin using a trailing stop at that point. So we started using a trailing stop right here, and it really didn't even violate that until just last week. So we stay long as the put-call ratio signal is still in place, and then if it switches, we still take a close look at it to see whether we really want to keep with it or not. Here's Beyond Me. Now this one's sort of interesting. It gave a local maximum here, buy signal, but there was obvious resistance on the chart there, so we waited for it to break out. In fact, waited so long that I actually removed the signal from our newsletter, but it did eventually break out. So you had a combination there of a technical analysis breakout and a put call ratio buy signal. Sometimes just out of the blue, you'll get an extreme ratio. This is Apache oil. You can see that, the stock was not doing well, but there wasn't much going on in the put call ratio. It's just bouncing back and forth here in, short range, narrow range. And then all of a sudden, on this last breakdown here, the put buying was really crazy, and it gave a buy signal there right at about the 1st of December. After that, the stock just took off to the upside. And again, we have been using a trailing stop on that. And I believe we're still in that one, the remnants of it anyways, but we've rolled up several times. So what happens when the underlying moves in our favor, and we've got these in the money calls, we'll roll them up to at the money calls and keep our same quantity, but that lets us take money out of the position and still have upside potential. Alibaba was one that was on a various, we had a sell signal here at a very low local minimum, but it really didn't work. It went higher. But then it was followed by another sell signal right after that did work. This is not it's not high enough to be a buy signal, but it was enough to stop us out of that trade. And then most recently, we had another sell signal right before the thing broke down. That's had a couple of big updates here as China has recovered, but it really was a well-timed sell signal. We're still in that one. We can do this with futures too. In this case, this is the top chart is the continuous chart of coffee futures, and the bottom is the put call ratio of the coffee futures options. Now, so we're using that, and you can see again, local minimum on the chart is a sell signal, very low, down in the 0 percentile, and it did break down. We're actually trading this with an ETF, the JO, which is an ETF that trades, like stock options, and it follows the price of coffee. Similarly, this is a fairly recent one, copper futures. On the left, you see the copper futures chart on top with the put call ratio of copper futures options on the bottom. And I don't know if you're aware or not, but copper has been in a pretty severe downtrend in the last few weeks, so that gave us a pretty good sell signal there. But we were actually trading it with FCX stock options because FCX behaves very much like the price of copper. And you can see in this case, it has its own fairly liquid option trading. It has very liquid option trading. And so again, it also had a local minimum there for a sell signal in FCX. Anyways, let's move on to the third category because we only have 40 minutes here. And the third thing we look at is breadth. Now, there's a couple of things you can do with breadth. Breadth, by the way, is just all stocks. You look at all of them and you take the advances minus the declines. You can keep a cumulative total of that. So it's somewhat interesting, only for negative divergences. So sometimes you'll have S&P breaking out to new highs, and the cumulative total of the advances minus declines is lagging behind. That was a very good key to market tops in like 2000 and 2007. Recently, though, it's been keeping pace on the upside with the S&P, so it's not been a negative indicator recently. You can also, we calculate an oscillator, and the oscillator daily is calculated this way. It's 90% of yesterday's oscillator value plus 10% of the difference between today's advances minus declines. Now, we use New York Stock Exchange data. Obviously, that's the easiest place to get advances minus declines, and there's also NASDAQ data. But the New York Stock Exchange trades things that are not stocks, and so the numbers are distorted. So we were, years ago, looking for a good place to get just stocks only data. And the New York Stock Exchange does publish what they call operating companies only data, but that also didn't seem all that great. But we realized we have a great set of stocks and that's all stocks that have options listed on them. It's good because it has NASDAQ stocks, it has big cap stocks, small caps, all those things like that. So that's what we call the stocks only. This is a chart of the stocks only breadth oscillator over, it goes back, this chart goes back to 2013. And we consider the oscillator to be oversold if it gets below minus 400 and overbought if it gets above plus 200. Now, let's skip over here. This is December 24th of 2018 when the market was just being completely buried. That was the most oversold reading in history for this indicator. But being oversold, as I said before, oversold does not mean buy. We didn't actually buy until here when it stopped being oversold, which I believe was somewhere around early January 8th or January 4th or something like that of 2019. Then the oscillator went into extreme overbought territory as the market went sharply higher, huge breadth, huge volume, all kinds of technical indicators registering amazing, all-time levels, which led to this statement that's at the bottom here, that oftentimes when you get that much of an overbought condition, it's really bullish for the longer term health of the market. So the rally that we've had over the past year emanated from that extreme overbought condition. Eventually it did, though, give way to a sell signal in here and back and forth. Most recently, it got oversold earlier this week, and just today went back above here for a buy signal. So that's on a short term. You can see that bounces back and forth fairly quickly. There's a lot of signals per year, and so this is one that we usually look for other confirmation beyond just this signal, but that is on a buy signal. In fact, so is the other one. As I said, it can flip back and forth quickly, which it's an advantage in a market that's going to be crisscrossing a lot. And if we are going into a trading range, bouncing sharply between the highs at 33.30 and the lows at 32.20, this could be one of the better indicators that, because it can quickly shift gears. So right now, both the New York Stock Exchange oscillator and the stocks only oscillator are on sells. That's supposed to be buy. Sorry, they just both turned to buy the last couple of days. Well, I guess I wrote this yesterday. Said the stocks only is already oversold. It came out of that and gave a buy signal. So these are on buy signals as of the last 2 days. Now, what about volatility? Volatility is something we pay a lot of attention to, and both short term and longer term. Longer term, the trend of VIX is very important. It generally trends opposite to the stock market. And while you might not think VIX is trending all the time, and it's not, when it's not trending, then that's okay, stocks can rise. But when it is trending higher, that's time to be cautious about the market. Also, sometimes VIX will form a spike peak on the chart, and that's a buy signal for the short term there as well. Short term meaning like up to a month or so. So, for a long time, late last year, VIX was very low. That's overbought, of course, but again, overbought does not mean sell, so it's not bearish until VIX begins to rise. So here's the VIX chart, and these B's here are all the system that we built around VIX spike peak buy signals. Again, a red signal is a winning trade, blue signal is a losing trade, and here you can see we had several all within 1 month of each other, so we only count the first one, we don't really trade the others. Sort of same thing there. Again, successful signals, and we just got one the other day. I believe it was last Thursday, and it almost got stopped out this week, but it didn't. So this buy signal here, the VIX spike peak buy signal, is still in effect, and we bought positions last Thursday to in line with this system. So you can see here, though, that VIX itself seems to be in an uptrend, and that's from an intermediate term viewpoint. It is. So it never closed above 16, even on all these little spikes up here. It hadn't closed above 16 since last October. Finally, it has closed above 16. Here's its 200-day moving average. It closed above that too. So those two things put together, we consider that to be an uptrend in VIX. So for the intermediate term, longer than just this short-term buy signal and the spike peak buy signal, for the intermediate term, VIX is negative as well. And it will remain negative unless it falls back below this 200-day moving average, which is just about 15 right now. So right now, we're telling customers that as long as VIX stays above 15, that's a cautious sign for stocks. And again, we are trading the short-term signal separately. So, a lot of our work, our intermediate term signals are our core position, as we call it, and then we'll trade around that with shorter term signals. So just to repeat, in the intermediate term, VIX is negative for the stock market while it stays above 15. Today, by the way, it's still above 15. It closed at 1605. And it's the 200-day moving average, which is going to make the determination here of whether it stays negative. If it falls below that, then it's back in a bullish stance. On the short term, of course, we have the spike peak buy signal, which is, as long as it's not stopped out, and by the way, this current signal would be stopped out if VIX closes above 1902 on any particular day. And then we have a system built around this. If you're a subscriber to our newsletters, we explain the systems that are not secret things. But that's our stop for this buy signal. And it almost got stopped out on Friday, I think it was, but it didn't. And so that's going to remain in effect for 22 trading days, and then we'll get out. So those Bs, those buy signals on that chart, none of them, we didn't stay in any of those positions for longer than the 22 trading days, which is about a month, calendar month. So there's another thing in volatility that we look at, and that's the relationship of the VIX futures and the VIX derivatives to each other and to VIX itself. So we can look at a couple of things. We can look at the relationship of the futures trading at a higher price than VIX or lower price than VIX. And number two, what's the term structure? So right now, February is the front month future, and then March, and then April, and then May. And if they're sloping upwards like this in price, then that's bullish for stocks. On the other hand, if February is above March and they're sloping downward like this in price, that's bearish for stocks. So right now, this indicator is very tenuous. It's kind of right between bull and bear. So it's bullish again, as I said, when the futures are trading at a premium and the term structure of the VIX futures slopes upwards. But when the opposite happens, it's bearish. So right now, it's struggling to stay bullish, but and it's so far managed to do so, but you'll see here with some actual data that's a little bit tenuous. So I grabbed this data about an hour ago, so I could give you as up to date as possible. So at that time, VIX was trading at 1603. As I said, it closed at 1605. So that's relatively the same thing. The Fed front month futures were trading at 1658. So 1658 minus 1603 is 55 cents. So the futures, these front month futures are trading at a 55-cent premium to VIX. And you can see that all the other futures are trading at a premium to VIX too. Not a very big one. I mean, if we looked at this a month ago, some of these were bigger than 5 out here on that end, and they're greater than 250 down on this end, or maybe 3 here. So the premium level has shrunk a lot, but it still stayed positive. Now, what about the term structure? Well, you can see February is trading at a slightly higher price than March, but then from there, it kind of bumpily goes higher, and not a whole lot higher, but it's still going somewhat higher. So this is sort of a tenuous bullish scenario. The futures are trading at a premium, but it's small, and the term structure is sloping upwards, but only after the second month, and not up that much, sloping upward that much at all. Earlier this week, it was flirting with a negative term structure, and many times in the past, negative term structures have signaled extremely bearish markets. If you don't have access to the VIX futures, although everyone does, because if you go to CFE, which is the Chicago Board Futures Exchange, so cfe.cboe.com. The front page there has all the VIX futures and their in a delayed price, so you can see everything. But the CBOE also publishes 5 volatility indices. There's a very short one, a 9-day volatility. VIX itself is a 30-day volatility. There's a 3-month, a 6-month, and a 1-year. So again, these were the prices at the time I took this. You can see the 9-day is just slightly greater than the 30-day, and then from then on, they slope modestly upwards. So when this term structure is sloping upwards, that's also bullish. This little thing here in the beginning is not so bullish, but we're going to say this is mostly bullish. Now, there's one other thing that happened here. 2 or 3 days ago, so I guess it was Friday, VIX closed above VIX 3M, above the 3-month. So that sets up what we call a VIX crossover buy signal. And now you can see the reverse VIX is back below VIX 3-month. So that gave a VIX crossover buy signal as of Monday night, last night. So that was a pretty well-timed buy signal. Those are very short-term things. They usually last a week or less. So we're not chasing it now after a market move like this today, but it did give a buy signal as of Monday night. So just to summarize there, the VIX futures are trading at a small premium. The term structure of the VIX futures is slightly mixed, a little bit upwards. The CBOE indices term structure is also slightly upwards. So I'm going to call this slightly bullish. And of course, we had that very short-term crossover buy signal. I've seen the term structure a lot more bullish than this, and after 2 big rally days, you might have thought it would be more bullish, but it's not. Anyways, let's summarize here what we've got. So we know that the SPX chart is bullish above 3220, but there is that modified Bollinger Band sell signal out there. Book-out ratios are bearish and don't look like they're going to be changing anytime soon. The breadth oscillators just flipped back to buy signals in the last couple of days. The VIX itself, the longer term trend is still bearish as long as it closes above 15, but we do have this VIX spike peak buy signal in place. And then the term structure is somewhat mixed, mostly slightly bullish, and of course that VIX crossover was bullish as well. So how are we playing this? Well, we're looking at a core position as being bearish, basically on the fact of this and this. And I also thought S&P was going to break down. It didn't. It held that support. If it breaks there, then we will be adding to core bearish positions. Meanwhile, though, we are trading all signals. So we have traded this spike peak buy signal. We have a position in line with this sell signal, and we had some seasonal trades also, which were bullish, and we just took those off. So you can trade around your core position, and the core bearish position looked a lot better on last Friday than it looks today, but it's still in place. And I will say this, whether or not you buy into that argument, you certainly want to take some heavy defensive action if 3220 is taken out on the downside. I mentioned before, we don't really have any negative divergences. There's one other indicator we're watching, that's new highs versus new lows. It's sometimes a pretty good early warning indicator. And there's a signal here. We back tested this. The first day, after a long overbought condition, which we had, the first day that New York Stock Exchange new lows are greater than new highs, that's a sell signal. Well, here's how it has been developing recently, and you can see the new highs are well above new lows, and it created all this kind of open space. Here's the zero line right there. Back in February of 18, when it broke, that was pretty. It was a pretty good sell signal, because that occurred, I believe, on like January 20th, 29th, or something like that. So you could get short before the market broke. So we were looking for that here. It hasn't happened. Given all that negative action we had last week, new lows have stayed above new highs in terms of the New York Stock Exchange. So that's another indicator that we're watching out for. As I mentioned, there were some seasonal trades. These are finished. I'm just going to skip by these. We're almost out of time. And I just want to remind you that don't get complacent, because in 2018, after a big 2017 and into early 2018, we had a sell signal there, then a bunch of other ones all in a row, and in a mere 5 trading days, it wiped out the entire rally over 4 months. So respect that support level at 32.20 in S&P. If it's taken out, you need to take defensive action at that point. Now, I mentioned we're offering a newsletter, the Daily Volume Alerts, which not only trades all of these signals, but also looks for takeovers. We've had 3 takeovers here recently, and we're offering 30% off through February 10th. Just go to this link, optionstrategist.com/festival. We're also doing one Saturday a month. We're having a Saturday morning get together, and take a look at that. If you just go to the front page of our website, you'll see a link to that. Okay, so I'm done here. My 40 minutes are up.